Welcome back to another episode. So, in the last episode, in the first week of November, I had highlighted that this market is getting narrow in terms of market breadth. And the rally that you had seen from March 2025 to something like October, this was actually backed by majority of stocks at least mimicking the index in terms of performance. But somewhere from midpoint of October, you started seeing a lot of sell off happening in the small cap space and mainly the micro cap space. And of course, it would have happened in the SME space also, but that is a space I don't track that closely. So, this distribution led to more concentration in the market in terms of money flowing towards highly selective sectors and mainly the top 100, top 200 stocks and some mid cap select stocks also. Apart from that, if you look at the market at the point of recording, about 37% stocks are only above 200 DMA. This kind of a market is always tricky. This kind of a market is tricky because it leads to a lot of sharper pullbacks also. I'll just take you back to this period which I had covered in my last episode also. This period that you see, this period in the market was a period where roughly 40% stocks were above 200 DMA. So it was not that there were not rallies in the market, but there were swift reversals also. And in general, over the next 2-3 years, the market did not go anywhere. If you look at where we are today with respect to the previous high in Nifty 500 was I think 24,600. We are rotating somewhere in this region only. And now it's almost what 15 odd months that we are in a range where we cannot go above the previous high, at least in Nifty 500 broader market. And I don't think this trend is going to change so easily. I think this market is going to get highly selective, that is further selective, even on a day like today where RBI policy is announced and the general mood of the market is okay. You're still seeing distribution happening in microcap 250, small cap 250, small cap 50, small cap 150, mid cap, small cap 400. I'll just take you through some charts also. But this is a trend that is largely visible in the market. Breadth is getting narrower and market is getting highly selective in nature. Now, there is nothing wrong in market getting selective, but what happens is as of today, a lot of people know that money is flowing into banks, it is flowing into finance, it is flowing into certain pockets of capital market and defense, and yes, metals. There are many other sectors. When these sectors start to get overheated in the short term, then you start seeing pullback in the market, in headline indices also, because the other sectors or the other pockets of the market, which is the micro cap and small cap space, that generally is not getting any money. There is one more problem that is brewing in our market, apart from whatever I covered about global markets in my last update, and that is the problem of IPOs that are coming out. See, primary market is sucking out a lot of liquidity from our system, and that is why you need to understand how mutual funds or other funds have to apply for IPO, how much money they have to park just to get some kind of allocation, and that leads to relatively less liquidity in the secondary market. That is also one of the reasons that secondary market and the existing PFs are not working that well, whereas you're seeing headlines as though things seem fine. Things are certainly not fine in the market. Yes, I remain bullish in the market, but I think we should brace for more swings and more volatility. Now, the set of charts that I'm going to open, I'll be opening from a list of Nifty 500 index. Again, because I'll be opening about 150, 200 charts, so that cannot be taken as recommendation, but still I'll make a usual disclaimer that none of the charts that I'm opening up are an recommendation to buy or sell. So what you have to pay attention is the relative strength line. I'll first open the bottom 20% charts in Nifty 500 just to show you a couple of things. So if you look at the charts, this is a 50-day moving average. This is nothing but the division of stock price against something like Nifty 500. So you get a ratio chart. So if you look at these charts, the bottom 20% charts or the bottom 50% charts also, this is very common. This means price deviating away from 50 DMA and a clear lower high, lower low structure in terms of ratio chart, which tells you that the majority of stocks in Nifty 500 are actually underperforming Nifty 500. So I'll quickly flip through because there is a common pattern out here. You have to be careful that whichever stock or whichever instrument you're selecting for either positional trading or maybe deploying money for some long term also, it should not be having relative strength that looks like this. Because this tells you that if there were to be a correction in Nifty 500 index due to any reason, these stocks are going to fall more. So you have to be with strength in this market. And just look at all these stocks. As of now, I've flipped through about 30, 35 names. All these stocks have similar kind of structures where price is below 50 DMA, mostly below 200 DMA also, and the relative strength line is clearly sloping down. In some cases, there might be some base getting formed, but overall structure of relative strength still remains lower high, lower low, and it is coinciding with price. Look at this lower high, lower low. Look at this lower high, lower low. So this tells you that a lot of distribution is going on in these names. A lot of exits are happening. We'll only come to know in the next quarter when you study mutual fund data. My guess is that a lot of mutual funds are silently offloading some positions in a lot of counters and bringing money in sectors and pockets that are working well. And this could lead to valuation concerns 12 to 18 months down the line in sectors that are currently doing well. So, the stronger pockets of the market, which I've repeated many a times, those pockets will continue to see a lot of inflow. Can you see now I am at 117th stock from Nifty 500, and just look at this. All of these stocks are having the same structure. So this is typically an exercise that I do every evening just to get a sense of what kind of distribution candles are forming on the chart, whether candles are having long tails, strong closing towards the upper end, or am I seeing these kind of distribution candles where price keeps heading lower? Now what I'll do is, so such stocks where price is clearly forming lower high, lower low, and where relative strength is clearly sloping down, again the sample is Nifty 500 index, such stocks are about 60%. I would say 45% because remaining 15% are actually completely flat kind of stocks. I'll just show you those structures also. So you'll find many stocks that are in this kind of a structure where you actually zoom out. So you'll find that relative strength overall is flat. It's not that negative, it is not that positive, but it is relatively flat. I mean, stock would be at the same level where it was 1 year back. So about 15% stocks in the market are in such kind of structures. Can you see all these structures you'll find are common, where price 1 year back is roughly at the same level, relative strength is roughly at the same level, that is, it is flattish kind of relative strength. It is neither underperforming nor outperforming. Now I'll open up the top 10% charts from Nifty 500. I'll also take you through the mid small cap index 400. Now look at the top 10% stocks and see the difference. See the difference in terms of price strength, see the difference in terms of relative strength. These are the stocks that are outperforming the market. These are the stocks that are withstanding all negative news. These are the stocks where you're clearly seeing some demand. These are the stocks where there is clear accumulation happening. Now, how do you buy such stocks? This is not a 2022, 2023 kind of a bull market that you can get in at any level and stocks simply heads higher. So these are the stocks where you have to look at such stocks only when you see sharp pullbacks in the market. And pullbacks will come. It might come due to tariff, it might come due to some negative news, it might come due to anything, but pullbacks will happen in this market. And that is when you have to have conviction to go behind such structures that are clearly in higher high, higher low, and where relative strength line is clearly trending up, which means if the market remains stable, which means if the market moves up, then the odds of these stocks outperforming and giving you gains is relatively much, much higher as opposed to the bottom 45% names or the mid 15% names that are doing nothing but are just in a range. So can you see all these stocks? Yes, they are volatile. They are volatile because the current nature of the market is that there's no free money anymore. A lot of assets in the world are attracting a lot of funds. So obviously equities in general will struggle. Equities in general will take some time to perform. But I hope you understand what is happening in the market. Distribution in about, I would say, 60% of names, then about 10-15% are flat. And buying and accumulation is only happening in handful of names. And that handful, if I have to put a percentage, I would say about 25 to 24% stocks in the market are actually seeing inflow, where you're clearly seeing higher high, higher low on price and higher high, higher low when it comes to relative strength. What I'll do is I'll open up some charts from the mid cap, small cap 400 index. Again, I'll just open up bottom 10% names and then top 10% names to tell you what is happening. So most of the stocks you'll see, they have diverged a lot from 50 DMA and a clear downfall. There is an acceleration that has happened in the month of October and November. Now, I don't want you to see the overall relative strength chart. I want you to see what has happened between October and November. And you'll see the kind of decimation that is happening in the small and micro cap space in particular. Just look at it. I mean, stocks are heading lower with solid momentum. This is nothing but, and many of these stocks were actually leaders of the previous cycle. This is nothing but people who own these names, they are selling these stocks and putting up money in sectors in pockets where they are seeing momentum, where they are seeing some action happening. Look at these stocks. You'll clearly see in the month of October 15, there's been clear momentum driven downturn in majority of these stocks. So we have now covered about 30 odd stocks. The pattern is the same. Trend is accelerating on the downside. Of course, if you look at the structures where stock is deviating too much from 50 DMA, you look at the small cap, micro cap indices also, there will come a time where some form of value buying will also emerge. But it's going to take a while for micro cap and small cap in particular, these two pockets, to start delivering a lot of returns that people have gotten used to in the year 2022, 2024. I still find a lot of people are stuck in that zone, in that phase where easy money was available in the market. Now, easy money is not available in the market. And people do have a tendency to chase whatever is working in the short term, which is why you're seeing so much of speculation in gold and silver. Why? Because a lot of content, a lot of post, everything is being made about these asset classes. Now look at the top 10% names. I'll quickly flip through chart because the message essentially is the same. So I don't want to sound repetitive, but this is what you have to look for: a clear higher high, higher low structure, and then a rising relative strength. Of course, now you'll start seeing things flatten out, which tells you that just 25 to 40 names probably in the mid small cap 400 index, where there are 400 stocks, are in the right structures. Rest, either they are flat or they are seeing distribution. This is what is currently happening in the market. And that is why you're seeing a lot of speculative money that is moving towards now large cap, mid to large cap kind of names. Even if you take a look at something like a Nifty 200 index and then you compare it with, look at this index, it's in a beautiful higher high, higher low structure, right? And now you take any let's say a small cap ETF. I'll just open up small cap ETF because data gets updated for. So I'll open up, let's say, HDFC small cap 250. Look at this structure. Because it is an ETF, you're still not seeing the kind of damage that is visible in the stock. But from all-time high, if you want to measure what the ETF has done, it is given a negative return of 13%. If an index is down 13%, then stocks are going to be down anywhere between 25 to 35%. And that is what is happening in the market. Clear distribution in the small cap and micro cap space, and I don't think it is going to end so soon. If you look at the relative strength, now this is a relative strength of small cap ETF against Nifty 500. Look at the distribution. Even if it were to move up here, yes, you will see some movement in terms of price also. People will start rushing in that this is a new beginning of small cap and micro cap stocks, but it's not going to be easy. It's not going to be easy because a lot of assets exist that are demanding the attention of a lot of investors. Internationally, you have AI themes, you have gold and silver. Then within our markets, banks, finance, a lot of sectors are relatively cheap. Then you have a lot of influencers in our industry who keep posting about their portfolios in the US or abroad, and that also has a lot of impact on retail people because these guys have millions and millions of followers. So of course, certain percentage of people start thinking that US is where a lot of returns will be made. AI is the theme we need to go behind. That also has a cumulative effect, not an effect that can overall impact the market, but I hope you get the point. So our market is fighting for funds with respect to other assets that are doing relatively really well. Plus, let us not forget that this whole notion of why we don't need FII money and now we are a domestic driven market, this is something I have never agreed with. Perhaps in a mini cycle, I would have spoken that in this cycle, we don't need FII money, but overall, we need FII money. We need FII money because that is what brings momentum in the market. And momentum is when you make money. Either you become a really long-term investor and keep sipping in, Nifty ETF or Bank Nifty ETF or small cap ETFs or mid cap ETF or sector-specific ETF, or if you're a regular participant in the market who wants to hold position for 12, 18, 24 months, you need momentum to make money. If you don't have momentum, you won't make money. A lot of people who contact me, let's say on Instagram or on Twitter on direct messages, tell me that in this particular year 2025 I have not been able to make a lot of return. The only thing I want to tell them, or rather I reply to them, is that what has the market done in the last 1 year? In the last 1 year, market is down. it becomes very difficult to consistently make returns when the overall market is not working. So when these headlines come out, Nifty 50 hits an all-time high or some sector has hit an all-time high, underneath people are struggling. Underneath people are struggling because retail investors and traders generally are in the small cap and the micro cap space. So it may be an all-time high for fund managers or for people who like to make headlines, but it is not an all-time high for people who are in the market investing and trading in smaller companies. I want to give you this perspective because I don't think it is going to be that easy for the small and micro cap space to make a return so fast. Some stocks from those pockets will do very well, especially if they belong to the right kind of sectors. I won't repeat the sectors because I've repeated it so many times. But overall, that pocket will continue to struggle. There is a time and price correction that is going on. Excess valuation is also getting corrected, and relative valuation comfort exists in large cap, mid to large cap names, and even some mid cap names. So naturally, money is kind of leaving the SMID space, that is small and micro cap space, and heading towards the pockets where there is some relative comfort. And yes, there are a lot of concerns for the global markets also. Global markets, my last update was actually about global markets. And if you look at the global market is just about flat, not going anywhere. And I would tell you that the small cap space in global market is also a pocket where a lot of money is not flowing. It is mainly driven through AI themes. So at some point in time next year, it's not unthinkable that we will have a retest of this level. And that is a correction of just about 7 or 8%, which is nothing. But this retest, we may also have a deeper retest, like Michael Burry is speaking about, that AI bubble is going to burst. We are going to see a massive downfall. Those things can come. Those things can certainly come. And whenever that comes, that is where I think the micro cap and small cap space will bottom out. Again, that is just my educated guess. But be prepared for heightened volatility. Use volatility in the right kind of stocks whenever they are pulling back. And it's not rocket science. It is stocks that are forming clear higher high, higher low, where relative strength is forming clear higher high and higher low. Apart from that, all the bottom 20, 30% names that I was showing, the structures that is important, not names. Avoid such stocks. Because whenever the global cycle plays out, where let's say Dow Jones also falls 10%, those small and micro cap space stocks are going to fall 20, 30% more. That is what happens. If a stock is at 100 and it falls 40%, all right, and it comes down to the range of 56, 65, it can again fall 40% and go to the range of 30, 32. There is no rule that a stock only has to fall 30% and it becomes a buying opportunity. So be careful, be bullish in this market, but know where to be bullish. The exercise that we just did with respect to stocks, that is clear trending structure, do it for sectors also and identify which sectors are seeing inflow and then wait for the dip. That is the only way you will be ahead. Else, you'll keep buying the hype, the all-time high, and then you'll keep selling whenever the market does not move because there is no momentum. So risk reward is only when you see retracement near 50 DMA. Pay attention to structures near 50 DMA. Don't pay attention to structures that have extended a lot above 50 DMA because that will be prone to a lot of pullback. All right. So have a great weekend ahead, guys. Take care, be safe. And any query, you can please contact me on Insta. Just send me a DM either on X or Instagram. I'll definitely answer that. Take care and be safe.